Hello, this is Angus Murray from Castlestone Management. I wanted to present to you 9 slides with regard to an update on US equities as of the 15th of September. We have obviously seen a decline again in equity prices as concerns about the resilience strength of the US economy will lead to or could lead to higher than expected interest rates as the Federal Reserve acts to control inflation. It was certainly expected that the Federal Reserve would increase interest rates by 75 basis points this month. Expectations are that that may be as high as 1% as the US Federal Reserve tries to contain inflation. Of course, what is really happening is we are just going back into a more normal level of interest rates. And that normality is causing a concern, and you can see in the last 2 slides in this presentation that investors have therefore been selling equities and equity and bond funds and bonds at what we would consider to be probably the worst time. So he titled this presentation, "The S&P either bottoms or advances with the ultimate peak in inflation," and I will show you 2 slides with regard to that in this particular presentation. So the first 4 main points. Cause of concern is related to the strength of the US economy, which could lead to higher interest rates to control inflation. But interestingly, and I'll show you a slide, the Global Purchasing Managers Index has already peaked, which would give an indication, along with a peak in commodity prices, that inflation has actually already peaked, although it may take a number of months for us to determine that that's in fact true. Third point is the S&P 500 either bottoms or advances when inflation peaks. I have a slide with regard to that. And in the worst case scenario, the S&P 500 only declines for a few more months and then recovers very quickly, as it did back in the 1970s. And our last point, which is in the last 2 slides, is just highlighting that the amount of money going into cash is quite astounding. And you have to consider that when that money goes back into the market, nobody is going to be selling equities at that time because people will be buying bonds, which means the price will go up and the yield will go down, which makes equities more attractive. And anybody that has sold equities will have already sold them, and those that want to buy them will have to pay higher prices. So first of all, the strength of the US economy and higher inflation has led to the concerns over the last couple of weeks that rates will be higher and therefore equity prices have reacted and moved lower. You can see that the futures, the 6-month federal futures, which is there on the right-hand scale, is indicating that rates will go up more than were previously expected, and that is also the reason why we have seen equities decline in the last couple of weeks. But when we look at what's happening in the underlying commodities and at a purchasing managers index level, there is clearly a peak, and that will ultimately come through to a control and a decline with regard to the level of inflation in the US economy. When we look back in history, so this one's going back to 1942, each time we have seen a peak with regard to CPI, the Consumer Price Index, or the red line, we get a positive reaction in the equity markets. And you can see that from 1942 to a degree in 1947 and again in 1951. When we look at slightly more recent data, we saw it again in 1974 and 1980. But we very clearly saw something similar in the 1970s, although it wasn't perfectly timed. It may have taken a couple more months for equities to bottom, but they recovered very quickly. So all of that together is leading investors to be concerned. And you can see here, although there are quite a lot of numbers, but you can see the outflows which are occurring with equities, hybrid funds, which are both equities and bond funds. And those significant withdrawals are leading to a decline with regard to equities and also the price in bonds, which lead to higher yields. And inevitably that money has to come back into the equity and bond market, which, as I said, will lead to a rally in bonds in price terms, which will lead to a lower yield, which will make equities more attractive. More money will flow into equities, and we will get some significant upswings. And of course, just reiterating that again in a chart format, the equity outflows that we've seen and the equity outflows that we've seen in the last 4 weeks. And of course, it's important to remind clients again that if you miss out on the best 10 days in terms of a rebound in equities, you cut your overall return in half. So to put that in perspective, if you miss the best 10 days over 20 years, you cut your return in half. Therefore, we would strongly indicate that it is worth holding on to equities, if not adding to equities where possible at this point in time. If you need anything further on that, by all means, please let us know and we'll try and help you where we possibly can. Thank you.